To begin, we introduce the core message. The order in which you invest is often more important than the specific investments you choose. We will focus on prioritizing tax-advantaged accounts over taxable brokerage accounts, and then keeping diversification simple. This sets the stage for a practical, step-by-step guide. Next, we hook viewers by stating the brutal truth. Putting money in a taxable brokerage before maxing out tax-advantaged accounts causes ongoing tax drag that compounds against you. The goal is to grab attention and motivate viewers to learn the correct order of operations. Moving on, we set the agenda. First, we explain why investment order matters, then compare account types, present a clear hierarchy, simplify diversification choices, provide an action plan, and finally reinforce the learning with quick quizzes. Before continuing, we provide a disclaimer. This content is for education only and does not constitute financial, tax, or legal advice. Viewers should consult qualified professionals and verify current IRS rules, plan provisions, and contribution limits, which can change. Now we explain why order matters. Taxable accounts incur ongoing taxes on dividends and realized gains, which reduces effective compounding over time. By contrast, tax-advantaged accounts, such as a Roth IRA, allow growth without annual taxation, and qualified withdrawals can be tax-free. The result is superior compounding. Therefore, the general rule is to prioritize tax-advantaged accounts before using a taxable brokerage. Next, we visualize the investment hierarchy. The flowchart begins with building an emergency fund to protect against short-term shocks. Then, it directs contributions to an employer plan up to the available match, because the match is effectively a guaranteed return. If the viewer is eligible for a health savings account due to a high-deductible health plan, the diagram branches to add the HSA because of its triple tax advantage. After that, it highlights funding a Roth IRA for tax-free growth and withdrawals. If capacity remains, it returns to the employer plan to contribute more up to the annual limit. Finally, the diagram shows taxable brokerage accounts as the last step. Decision diamonds indicate whether an employer match exists and whether the viewer is HSA eligible. Building on that, we compare Roth IRAs and taxable brokerage accounts. Roth IRAs offer tax-free growth and tax-free qualified withdrawals, eliminating annual tax drag and encouraging long-term investing due to rules around contributions and withdrawals. Taxable accounts provide flexibility and fewer restrictions, but they impose annual taxes on dividends and realized gains and can encourage short-term trading. Taxable accounts are best used after tax-advantaged options are fully utilized. Furthermore, we show why Roth First often wins. Annual taxes reduce the effective growth rate in taxable accounts, and over decades this creates a large performance gap. For instance, with a 7% gross return and an assumed 0.5% tax drag, the effective rate becomes about 6.5%. Over 30 years, $100,000 could grow to approximately $761,000 at 7%, versus roughly $661,000 at 6.5%, a difference exceeding $100,000. Roth accounts also offer specific withdrawal rules and tax-free qualified withdrawals in retirement, and they reduce administrative tracking compared to taxable accounts. Now, we quantify the impact. With a 7% gross return, a Roth IRA with no annual tax drag compounds to roughly $761,000 on $100,000 invested over 30 years. A low turnover taxable account with an assumed 0.5% annual tax drag compounds to about $661,000. A high turnover taxable account with a 1% drag compounds to about $574,000. These are simplified assumptions meant to illustrate the magnitude of tax drag. Real outcomes vary with tax rates, turnover, and behavior. Next, we display a simple global allocation using a pie chart. 75% in a United States total market fund and 25% in an international total market fund. This achieves broad global diversification with minimal complexity. After that, we explore simplification further by using a single, globally diversified total market fund. This approach removes the need to rebalance between United States and international equities, keeps costs low, and provides broad exposure. Viewers should research total world or global all-cap index funds or ETFs from reputable providers and select what fits their plan. Consequently, we outline an action plan. First, list all your available accounts and confirm whether you are fully utilizing them. Second, redirect contributions to fill tax-advantaged buckets first. Third, Automate contributions to occur near payday to reduce friction. Fourth, choose a simple global allocation to minimize errors and costs. Fifth, review periodically rather than constantly monitoring markets. Moreover, we present a timeline reinforcing automation. Biweekly paydays trigger a sequence. Contributions to the employer plan up to the match, followed by HSA contributions if eligible, then Roth IRA contributions, and only afterward directing excess to taxable accounts. The timeline also notes maintaining a cash buffer for bills and an emergency fund. Now here is a quick quiz. The question asks, which order best captures the investment priority before using a taxable brokerage? Option A says taxable brokerage, then employer match, then Roth IRA. Option B says employer match, HSA if eligible, Roth IRA, then taxable. Option C says Roth IRA first, then stop entirely. Option D says only taxable accounts because they are flexible. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. Next, the correct answer is option B, employer match, then HSA if eligible, then Roth IRA, and finally taxable. This sequence captures the essence of prioritizing tax shelters before taxable investing. Moving on, the second quiz asks about an easy path to global diversification without constant rebalancing. Option A is picking random stocks. Option B is using a single, globally diversified total market fund. Option C is buying only domestic technology stocks. Option D is switching funds monthly to chase performance. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. Subsequently, the correct answer is option B, using a single, globally diversified total market fund. This approach keeps costs low, provides wide coverage, and reduces the need for manual rebalancing. To reinforce learning, we recap the key takeaways. Prioritize tax-advantaged accounts before taxable. Understand that Roth IRAs offer tax-free growth and qualified withdrawals. Recognize that taxable accounts experience annual tax drag. Keep diversification simple with a global approach, and automate contributions in alignment with the hierarchy. Finally, we summarize the main points. Maximize tax-advantaged accounts before using taxable accounts to avoid tax drag. Use a simple global allocation to reduce errors and costs. Audit and automate contribution flows for consistency, and verify current rules while consulting a professional for personalized guidance. As a creative close, we ask viewers to like the video, share it with friends, and subscribe for more content. We also invite them to comment with their personal contribution hierarchy and any adjustments they plan to make after watching.